All
And just to
right. Sorry, go ahead.
you're seeing my PowerPoint slide. It says top 10 ways to make more money, correct?
Yes, sir.
Okay, very good.
Yes, sir. So, I have gone ahead and started the recording. So officially we are underway. Again, my name is Alan Sama, and today I'm very happy to have Mike Scanlon on the line with us. Mike Scanlon is the CEO of a website called Born to Sell, which is a awesome covered call calculator or covered call screener. I mean, it does a lot of different things. And it's actually, I met Mike a couple of weeks ago, I believe, and I knew that I had to get up to him and talk to him because I have been a fan of Born to Sell ever since I found it. It was something that was very clean, very easy to use, and I was like, oh wow, this is so cool, this is so awesome, I need something like this. So, um, I'm glad, Mike, that you're been able to take some time out and share with our people exactly, what is a covered call and exactly what are the ways to make money. I mean, I bet most of our people have a little bit of a understanding, of what a call is, of a covered call, and how to do it, because it's one of the more simpler ways to trade options. And when you get started, that's like the first one that you're approved to do with the broker. But it's a little bit more complicated to do it right. Is that correct?
Absolutely. It is probably the easiest options trading strategy that most people start with, but there are definitely ways to do it better and other ways to do it worse. So, your mileage does vary based on your strategy. And thank you for having me. Would you like me to kind of jump into the presentation, or do you have some initial questions, or how would you like to do it?
Yeah, let's get started. And folks, please go ahead and put your questions in the chat box. And as we go along, I'll be, asking Mike what they are because he can't see them. So just put anything that you have, if you have any questions with you, or if you have something that you want him to look at or get his experience on, because he's been trading options for over 36 years. So he's been doing this for a while. I mean, his father was a stockbroker, and lucky for him, his father taught him how to do covered calls when he was 15 years old. So for those of you who have teenagers, it's never too young to get them started. Because, later on, that for Mike at least, that led on to a very illustrious career as a banker and as a engineer and a venture capitalist. So, obviously, if you want your kids to be wealthy and well off and have that freedom of not being limited by, what
We
job
just
they're
lost the
in.
audio.
Oh, okay. Sorry about that. Okay, can you hear me now?
Can you hear me?
I can hear you.
Alan, can you hear me?
Yes.
Okay, very good. You dropped out for a minute, sorry.
Oh, sorry about that. Yes, I was just telling everybody how wonderful you are.
Oh, well, thank you. I appreciate it.
And I was also saying that, I mean, you got started when you were 15 years old. And one of the things I really enjoy is helping young people get started in options. So one of the success stories that we've had is a woman or a young lady who was 14, and she started trading options, and really her father was like, I mean, she's getting so good at it within a short period of time that she's not going to have to worry about, job security or what kind of career that she has to go in, because she's going to be able to make money on the side and then do whatever she loves for a living. So it was great that your father set you up this way, and I hope more parents would do that. So with that being said, I'm going to shut up and I'm going to let you take over and teach us about covered calls.
Great. Well, thank you, and good afternoon, everyone. Today, we are going to talk about how to make more money with covered calls in general. And specifically, I'm going to just tell you 1 second on me. We're going to talk about the amount of time premium that exists in the world today. Look at a couple of long-term studies on covered call returns to kind of justify the strategy. Then we're going to talk about how to do two things. One is lose less, and the second is to make more. Then I'll show you a demo of our covered call screener and give you guys a special offer just for Option Genius listeners, and have questions, and feel free to jump in with questions in between as well. So as Alan just said, I've been doing this for a long time. I did have the benefit of kitchen table meals that involved talking about stocks and options when I was young, and that evolved into me trading full-time well, not full-time, but every night and weekend, I should say, for the last 30 years. I've been a technical person for a while, and then I was in finance for a while, and in the last 8 years I've combined those two things to create a website for covered call investors. It has won several awards, including first place in 3 of the last 5 years for the options category of trading software, as done by a popular vote on the Trader Planet website. So today there's 375,000 unique covered calls. That is every combination of underlying stock, expiration date, and strike price. From those 375K instruments, there are 155 million open contracts, and the sum of the time premium portion of those contracts is $14 billion. So that money at $14 billion is going to decay from $14 billion to zero by expiration. What happens at expiration? The majority of them are closed prior to expiration, but of those options that are not closed prior to expiration, about 75% of them are expire out of the money, which is why we feel it's better to be an option seller and not an option buyer, hence our name, Born to Sell, and not Born to Buy. Charles Schwab has said that 84% of their investors trade covered calls, and TradeKing has said that it is the #1 option strategy on their platform. So covered calls as a strategy is very popular. Well, why is that so?
Mike,
Yes.
should your slides be changing?
Yes. No, they haven't been.
No.
Oh my goodness. Okay, thank you. Let me try and do share.
Okay, I see your mouse moving. Okay, now I see the agenda slide.
The agenda, okay, good.
There we
I
go.
apologize.
Okay, it's moving.
All right, so we covered the brief bio, and these are some numbers that I just went over on the number of unique call options, the open interest, and the total sum of all time premium, and that the fact that 75% of those held until expiration expire worthless. A couple of quotes from the Wall Street Journal and from TradeKing talking about how popular covered calls are as a strategy. And then the reason why it's so popular is that it's fairly easy to pick a winner using the strategy, but there are risks, and the risks can be made worse by greed, the use of margin, and just generally not doing your homework. So what markets do covered calls work well in? They can work well in almost any market, but they're not the best strategy in very strong directional markets. So if it's a strong up market or a strong down market, you're better off either with just sort of buy and hold, or in a down market perhaps cash or short. But in other markets, covered calls are pretty good. And for a lot of people who are not trying to get rich quick, but they just want a steady, positive income stream or growth, covered calls work fairly well. The other thing they do for you is they lower your portfolio volatility. This is a study over 20 years that showed that the buy right index had about the same performance as the S&P 500 over those 20 years, but the buy right index did it with much less volatility. Down to the bottom you see 11% standard deviation versus 15 for the S&P 500, and smaller is better in terms of volatility there. So similar performance, lower volatility is a feature of covered calls. There have been a bunch of academic studies to beat this point home, and we have these listed on our website. They're free to download. The University of Massachusetts did a 15-year study. Asset Consulting Group did a 23-year study, and the results are similar to what I just showed. Here's the summary. This was a 15-year study that compared the Russell 2000, which is this black line, versus selling 2% out of the money covered calls on the Russell 2000, which is this dotted line up above. So over the 15-year period, you would have had 100% higher return using the 2% out of the money covered call strategy versus just holding the underlying straight. The Asset Consulting Group study was a 23-year study that compared two different covered call strategies. One was the BXM, which writes 1 month at-the-money covered calls on the S&P 500, and then when they expire, they do it again. And the BXY is 2% out-of-the-money covered calls on the S&P 500. And the results are that this first column is the BXM, second column is the BXY. They had higher performance than the S&P 500 over the 23 years, and they did it with less volatility. Smaller numbers are better for volatility here. So better returns with less volatility over 23 years. And you might say, well, they just cherry-picked a time period there. But if you look at that study and you compare it, the 1-year numbers, the 5-year, the 10-year, and the 20-year, in every time period, both the BXM and the BXY outperformed the S&P 500. And this report is downloadable on our site as well. So what is a covered call? It's a two-part trade. One, you buy 100 shares of a stock or an ETF, and then you sell one call option against it, since the call option controls 100 shares. And I'm not going to go into specific details on that trade, but if you need, if that's not super clear, we have a covered call tutorial on our site, which is free and goes into some examples. You can check that out. In a simple form, though, I want to show the P&L graph. This is a standard buy and hold graph, this orange line. You buy some stock, and if the price goes up, you make a profit, and if it goes down, you lose. Let's compare that to writing a call option. So we take that same stock, and we short a call option against it, creating a covered call trade. And now we're going to end up on this black line, which for many points on this graph, the black line is above the orange line. That means the covered call is more profitable than the buy and hold. Now, if the stock goes up a lot, the buy and hold will do better because the covered call has put a cap on your upside. But for many other ending stock prices on expiration day, the covered call is doing better than the buy and hold investor there. And for a lot of people, it's not about doing the best, it's just about doing okay. And they want to earn 1% to 2% a month and just not lose. And covered call does help them achieve that. So the pros of the strategy is that you're going to get cash on the day that you sell these call options, as you do with any op strategy where you sell options to other people. You can create yield on stocks and ETFs that you own that may not pay a dividend or have no yield. For example, gold, GLD, pays no dividend, but if you want to have exposure to gold, why not write calls against it? Now you have an income-producing gold stock. It lowers your break-even point because you can reduce your net debit or your purchase price by the amount that you receive for the call income. So that makes it more conservative than buy and hold because you have a lower break-even point than buy and hold. And it also will lower your account volatility because the first part of any drop in the stock price will be insulated or sort of taken up by the call premium that you received. The negatives are that if the stock runs up to the upside, you're not going to capture all of that because you are putting a cap on your upside by selling a call option against it. And you can still lose money if the stock drops below your net debit, which is defined as your stock cost minus the call premium that you received. So it's not a guarantee, nothing is. Now we're going to talk about two ways to end up with more money. The first is to lose less of what you have, and the second is to make more than what you started with. The first key is diversification. This goes across covered calls, but it's always good to repeat. If you had, say, a $50,000 portfolio and there's maybe 5 stocks that you liked, and say they're all similar because you're a techie, what should you do? Should you buy 10,000 of each of 5 things, or should you pick maybe 2 of them for 5,000 each, and then go find $40,000 of non-correlated, non-tech investments, which is obviously the better choice. In general, you don't want to put more than 10 or 20% of your account into a single sector, and this goes across investment strategies beyond covered calls, but it is also very true in covered call investing. This graph kind of hits that point home. Our software will take the S&P 500 and break it down into 9 basic industrial sectors and shows you the percentage of the S&P 500 that is made up by each of those 9 sectors. Those are the orange bars. And then we overlay your portfolio on top of that, broken down by sectors. So in this example portfolio, it's very heavy in financial stocks and technology stocks. It's about half financial and half tech. So the visual that you're seeing here is this portfolio is way overweighted on financial and tech and underweighted in everything else. So if you wanted more diversification, here you'd want to sell some financial and tech stocks and buy some stocks in some other sectors. Related to diversification is position size. Let's imagine again you had $50,000 and you thought that XYZ stock was going to go way up. So you have a choice. What do? You buy 50K of XYZ, going for the big win, or do you buy a little bit of XYZ and then look for 9 other things that are not correlated, which is obviously the better choice. In general, you don't want to put more than around 10% of your account into any single investment. Earnings dates are high volatility points, and it's generally not a good idea to invest just prior to earnings. Sometimes when you use a screener like ours, you'll see a bunch of things bubble up to the top that have crazy premiums, but they all have an earnings release date prior to the option expiration date. In this example here, I've got the screener set to March 17th, which is this Friday. These stocks all have an earnings coming out between now and Friday, and the annualized return on these covered calls is, over 140% on all of these. So very attractive returns, but super high volatility events in the next couple of days as well. So can't recommend doing that. We show the dates in red here if the earnings happens prior to the option expiration date that you're looking at, and just as a warning, heads up. We also allow you to get rid of those things with one click. We have a feature called earnings before expiration, and if you uncheck it, it will remove all covered calls that have earnings prior to option expiration in one click, so you won't be bothered by those high volatility candidates again. Related to earnings is sort of a related companies issue. Like, let's imagine that you're looking at Yahoo, maybe not a great example since they're about to not exist, but say that premiums were really high, but there was no earnings coming up. What's going on with that? Well, it's possible that another company in their space, like Google, perhaps has earnings prior to the expiration date of the Yahoo call options that you're looking at, and Google's earnings will affect Yahoo's price movement. So that could be a related stock issue. And it happens between telcos or snack companies or banks. One can affect the other. So eliminating the earnings dates prior to expiration is not the only source of risk. You have related company earnings risk as well. Another one is the FDA, the Food and Drug Administration. Their announcements can either double a stock or cut a stock in half, depending on whether or not typically the biotech thing that they're looking for approval on is approved or not approved. These can be even more volatile than an earnings announcement because they often make or break a company. There's no way to automatically screen these out because the FDA calendar is always in flux and meetings get rescheduled. But if you like to invest in those kinds of stocks, there's a couple of resources I've listed here where you can go find a calendar and literally check it every day, and they'll tell you which companies are about to have an announcement come out. And if you can't find anything there, a good strategy is go to a stock board and post a question to the general audience and say, hey, why is this stock so crazy right now with these premiums? And someone inevitably will know the answer. Another category of things you want to stay away from is rumors, which would be mergers and acquisitions, new product announcements, the iPhone 8 release date, for example, legal settlements that may or may not be pending, what the local billionaires are doing. I don't know if you saw it, I think it was Ackman announced he got out of Valiant last night and the stock dropped 10% today. So that's something you just can't protect against, and generally not good to play with those kinds of stocks with covered calls. Now if the rumored event has come and gone and then you still like the stock, then okay, you can probably get in, but I wouldn't take advantage of the high premiums that are based on the rumor. Margin can be a good thing if you're in the right direction, but it's also a really good way to lose a lot of money and lose more than you thought you would. So can't really recommend it for a conservative investment strategy like covered calls. Leverage ETFs is a whole class of stocks you should stay away from when writing covered calls. At the moment, there's 141 ETFs that are double leveraged, and there's 96 that are triple leveraged. So these are instruments specifically designed to have the 2 times or 3 times the daily performance of whatever thing that they're mapped to, and they're generally for day trading. They're not for multi-day strategies, and covered calls are definitely multi-day, if not multi-week or multi-month. Strategies. We have a way to filter them out, a checkbox. You can say take all the leverage ETFs out of my results list, and then you won't see them, so you won't be tempted with their high returns. Unknown fatness, if their premiums are really fat or juicy and you don't know why, you got to figure out why before you invest. Otherwise you're just gambling blind. This was an example I just took a few minutes ago, and there's annualized returns here of 200 to 300%, and a couple of them have earnings before expiration that can explain that kind of volatility, but the other three, I have no idea why these stocks are offering 200 to 300% annualized returns. So I would stay away from those until you figure out the reason why, and odds are it's some rumor and you probably should stay away anyways. So if you have one of those and you don't know why it's trading so heavy or so richly, how do you figure it out? The simplest way is often to enter the symbol at Yahoo News, and you'll see a list of recent headlines regarding that stock or rumors, and that usually answers the question right there. If that isn't clear, then you can go to one of the discussion boards and post a question and say, hey, what's up with this symbol right now? Why are these premiums so high? There is a group specifically for covered call investors that I want to mention here. If it's in Yahoo groups, it's called Just Covered Calls, all one word together. And if you go to Yahoo groups and search for that, you'll find it, or here's the URL as well. And that's a really, safe place to ask questions, beginner or advanced, and there are some really good covered call traders there who will take a lot of time to answer your questions for you. So that's how you lose less, is by staying away from a lot of risky situations. Now let's talk about how you can make more. You should apply the covered call strategy consistently over a long period of time, because in the short run anything can happen. But all of the studies that average 10 years or 20 years have the same outcome, higher returns with lower volatility when the strategy is applied consistently. We're going to talk in the next few slides about how to turn non-dividend stocks into dividend stocks, how to double your dividends if it already pays a dividend, or if you have a target yield in mind, how to achieve that specific target, how to do a dividend capture strategy, and how to make money through time premium capture on really short-term covered calls. And also, I always get asked a question about transaction costs, so we'll talk about where to trade for less money. So how much can you make? This is sort of the level setting question. A reasonable goal is 1% a month. That's 12% a year. That's fairly easy to do with covered calls, as long as you have decent diversification and you're not trading on crazy margin. Some investors, covered call investors, will target 2% a month, realizing they won't make it every month, but the losing months should be small, and on average, they'll end up with 15% a year, which over a long period of time is a great outcome. You will see claims on the internet for people who say they can make 3 to 5% a month with covered calls, and while that may be possible with a single trade or once in a while on a monthly basis, you're not going to do it every month. There is very little chance you're going to make 60% a year trading covered calls. And if you do margin, you're going to amplify all of the above numbers. So the first strategy a lot of people do is, how do I take a non-dividend paying stock and make it pay dividends? Well, you can sell out-of-the-money calls on every stock that you own. And a rule of thumb is to set the strike price 10% higher than the current price, which is going to make for fairly small premiums. So you might have to set the expiration date far enough away so that the premium is meaningful relative to the transaction cost to do it. In these examples below, this is from a while ago, but these were 60-day options, and I ended up getting a 11 to 12% annual yield from 3 companies that didn't pay a dividend, but I set strike prices that were 10% or more out of the money and 60 days in advance. So you do that 6 times a year, and you can get maybe 11% a year yield from a stock that doesn't pay a dividend. Some stocks do pay dividends, and you can use covered calls to generally double the dividend, which is a common goal that a lot of people have. The way you would do this math is you take their annual dividend and divide it by 12. So if it were paying $1.20 a year, you would look for something that had 10 cents a month in call premium in order to achieve $1.20 a year in total yield from the calls. So here's a couple of examples. Kraft has an annual dividend of $1.16. That's 2.8%. So if you were to get 10 cents a month premium from that, that would be another $1.20 a year. And the total yield, if you did every month, would then be 5.6% from a stock that only pays 2.8% dividend. These larger, more stable blue chip companies typically have lower call premiums because they're not so volatile. Some people want to target a specific yield, so they say, I want to earn exactly 1% a month or more, and I want to do it with conservative, deep in the money covered calls. I don't really care about capital appreciation, but I'd like to have the call premiums generate at least 12% a year. The way you can do that is first remove all the risky situations, the thinly traded stocks, your biotech or healthcare, any other kind of risk events. Here's an example from today that I took. These options expire in 39 days. And I'll just read the first one here as U.S. Steel is trading at $35 a share. You could sell a 31 strike and receive $5.35 for it, bringing your cost down to $30.36. And if all goes well, that'll get taken away from you at 31 on April 21st. That gives you 15% downside protection. That means that U.S. Steel could drop 15% and you would break even. And if it stays above 31, and again it's at 35 today, you will make this annualized rate of return over here on the right, which is 19%. So that's a way to do a bunch fairly conservative. These are all in the money. These strike prices are all below the current stock prices. Dividend capture is a strategy used by short-term covered call investors where they want to find a covered call that has an ex-dividend date prior to the expiration date and then capture the dividend as well as the option premium. So we have a feature that will limit the results to only stocks that have an ex-dividend prior to the expiration date you've chosen. Now, sometimes you'll have early exercise on these, especially if the ex-dividend date is just prior to the ex-dividend date is just prior to the expiration date. And lost my train of thought, I apologize. The early exercise on these, if they're in the money and the expiration date is close to the ex-dividend date, you may get early exercise. It only makes sense if the option literally has 0 time premium left in it. So the way to avoid early exercise is to sell an option that has more than 0 time premium in it. And then it's not to the option holder's benefit to exercise that option. He'd be better off to sell the option because he forfeits any time premium when he exercises the option. We have a whole article on that subject on our site, by the way, an early exercise and when it may or may not happen. Time premium capture is the most common reason to sell covered calls. People will sometimes buy stocks specifically to sell it in the money or deep in the money, covered call on it, hoping to get called away on expiration day and then repeat the cycle. They often do this with weekly covered calls. They're not interested in capital gains. They just want to calculate in advance how much can I make from the time premium, and as long as it gets called away, I'm going to make that amount. There's a lot of transactions in this kind of trading, so if you're at a high cost broker, it's not a good strategy, and if it's in a taxable account, it can make your tax reporting kind of tricky, so you may want to do this in a tax deferred account where you don't have to worry about that. And some people will do this on margin because they can borrow money, especially right now, at very low margin rates. If you can borrow it at 1 or 2% and then have an annualized return of anything greater than that, then you make the spread. But of course, with all margin trading, you run the risk of losing more than your initial investment there. So which strike to use? If you want the absolute most premium, the at-the-money strike is always going to have the highest time premium. The out-of-the-money strike leaves you some room for capital appreciation, and the in-the-money has more downside protection. So what is, quote, best really depends on you and what is your return goal, your risk tolerance, can you handle a loss, where do you think the stock's going to be on expiration day, is this a taxable account or not, a bunch of variables like that. So there's no single best answer for all investors. What I can tell you is that or visually show you here is on the SPY, I've taken 5 different strike prices ranging from 138 to 146. And the bright green color here shows you the amount of time premium in each of these options with the same expiration date. So this middle one at 142 is the at the money. The S&P was, the SPY was 141 when this was taken. So very close to at the money. You can see this green bar is the highest of the green bars, and as you get further away from at the money, both in the money and out of the money, they're kind of symmetrical. This green bar, number 2, is about similar size to this green bar, number 3. Likewise, number 1 is similar in size to number 5, equal distance away from the current moneyness. So which expiration date should you use? Generally, covered call investors like to sell short-term options because the option decay curve is nonlinear, and the sum of 3 one-month premiums will always be greater than 1 3-month premium because of how this curve works. So you want to be on the right side of this curve and generally sell options that are 30 days or less to expiration. A lot of people do this with weeklies, so they're literally trading 7 days at a time. So what stock should you choose to do a covered call? First, you have to remove a lot of risk events. I would say that anything with a high PE multiple or anything that's a news story that's a momentum stock, those are probably not the best candidates. Anything that's thinly traded or has a wide spread is not a good candidate, because if the stock has a wide spread, the options are going to have a wide spread, and if you ever need to roll that position or exit it early, it's going to be costly. Tiny market caps can be volatile. Things that don't, an option that sells for 10 cents is probably not worth doing given transaction costs unless you're trading 100 contracts at a time or something. Obviously no ETFs, no leverage ETFs we talked about, and anything that has an earnings announcement is probably not a good idea. Now you can use a screener to reduce the world of choices, and here's an example where we started off with 230,000 possible covered calls, and then we removed a whole bunch of risk events, leverage ETFs, anything less than $5 a share, so low price stocks, high PE stocks. Then we chose a specific expiration date we're interested in. We removed everything that had earnings before that date. We removed small market cap stocks, anything less than 500 million, small premium options. We made sure the annualized return, if flat, meaning the stock is unchanged between today and expiration, was at least 12% a year. The option needed to be in the money, 5% or more, so have some downside protection. Needed to have some open interest of at least 2,000 contracts, so the spreads wouldn't be too wide. And we wholesale eliminated healthcare to remove FDA risk, and the result of this funnel is now we have 38 possible covered calls to consider after starting with 230,000. So what do you do with the 38? Well, now the homework really begins. You want to go look them up, read the news, maybe post a question. Hey, I'm thinking about investing in this stock. What do people think about it? Study the technical factors, and don't just buy it because you want to write a covered call on it. You may end up owning it past the expiration date, even if you sell an in-the-money covered call on it. So just be careful, or you're going to end up holding a bunch of stocks you don't know anything about if they go down a little bit after you bought them. I always get asked which is the lowest cost broker or where should I trade, and stockbrokers.com has, in my opinion, the best review of stockbrokers. They just came out with it about 2 weeks ago, and they took 6 months and analyzed 300 variables, came up with 13 different categories for the best. And here are the answers for some of the best. On commissions, Interactive Brokers wins. Platform is TD Ameritrade along with education. And options trading, they gave it to Options House. And for very active traders, they gave it to Interactive Brokers. So if you're not trading at something on this list, you might want to consider looking at these, at least open a little account. Most of them have paper trading accounts. You can try it for free and just to get a different experience. And go read the report at stockbrokers.com if you want an in-depth analysis of why or specific to your type of trading, which one you should use. If you have questions on covered calls, like I said, really the best place to go is this Yahoo group called Just Covered Calls. We have some free resources on our website as well. We have a covered call tutorial. We have a blog that we publish to about once a week, and I'm available for questions as well. We're going to offer you guys a discount for being patient here and listening to this, and I'm going to show you a demo in just a minute. But if you're interested in our screener, you can get a discount by going to borntosell.com/optiongenius, and the keyword is genius. If you enter the word genius in the field that says how did you hear about us, when you sign up, then you will get some bonus time added to your subscriptions. And we offer 3 types of subscriptions: monthly, quarterly, and annual. Okay, Now I'm going to give a demo unless, Alan, you have any questions, or should I go right into a demo here?
We have a few questions. If you want to go that first, we can do that.
Sure.
Whoops. Okay, so we have Jerry who's asking, you might have covered this, but he wants to know what is the safest time to expiration?
The safest time, I'm not sure I understand.
So I guess I think he's saying that, what is the best or the safest time to be in the trade? Obviously, you have the 30 days, which has the good time, the theta decay. You also have the weeklies. So are they, one versus the other? Should you go 30 days, 60 days, 2 weeks, a week?
Well, I guess it depends on how long you intend to own the stock, and if your reason for buying it is just to write calls against it, or having it have a different reason. Like if you own Apple and you say, I want to own Apple for 30 years, you can probably write options that are 1 month. I wouldn't necessarily go out beyond 1 month. If you're buying a stock specifically to write calls against it, the weeklies are great because you're limiting yourself to 7 days. That's what most people do. We track these statistics on our site, and I would say the vast majority of our covered call investors will write 1 to 2 weeks out. The more conservative long-term buy and hold type of people, they'll own a diversified portfolio of blue chips, and they'll probably write options that are 1 month out, maybe 1 to 2 months out, because the premiums aren't very high on those stocks. And so you need to write a couple months out to get anything for the options. But if the stock has any kind of volatility at all, I would say the weeklies 1 to 2 weeks out is probably the right way to go.
Okay. All right. Chuck is asking, do you ever use married puts for stocks being held long term?
Personally, I don't. I know it's a popular strategy. There's certainly nothing wrong with it. It eats into your profit potential a little bit, but it also lets you sleep at night. So it depends how leveraged you are, if at all, and if the thing that you're holding is a volatile entity or not. And what is your long-term outlook on it? If the thing drops like 20%, would you still hold it for the next 5 years, or would you just give up and move on to something else? So it kind of depends on the situation, I guess. Also, what is your cost basis? Like if you bought it at 2 and now it's at 50 and you don't want to give it all up, give back all the gain, certainly buying a put there would be a good way to protect that gain, but they're not free.
Right. Right. Okay. Steve's asking, do you recommend or why not Tastyworks? I guess Tastyworks is a newer broker, right? So
I have no experience with them. I'm sorry, I don't know them.
okay. Okay. Yeah, I mean, I've heard of them. I've heard right now they're giving good rates, but they're brand new and they're just trying to get new people. So, have
I was going to say I've traded interactive brokers a lot, and that's where I do most of my trading. It's not super simple, so I don't send people who are new to interactive brokers, but if you're an experienced trader, I love their tools. But I mean, Options House is good, TD Ameritrade is good. Those are probably the top 3. Most of my customers are one of those 3.
okay. So another question is, if I want to hold on to a stock and still sell calls, and the stock price goes above the short strike, what is the best way to handle that?
So you still want to own the stock, and now it's in the money.
Yeah. So I mean, I kind of, I'm kind of in that same boat because now what I do mainly is in my IRAs and my retirement accounts, I have a lot of these blue chips that you mentioned, and just to generate that extra yield on it, I'll sell calls against them. So then, like, let's say they go in the money, what should I do with it?
Well, if you want to keep it long term, definitely your only choice is to roll the option. If it's in a tax-deferred account like an IRA, you can let it get called away. And at a place like Interactive Brokers, there's literally zero cost for an option exercise against you. So it costs you nothing to have it called away, and then you end up with a bunch of cash. On Monday after the weekend, you can go and use that cash to buy more shares of that stock and start it again. Now that's if you're in tax-deferred account. If you're in a taxable account, you need to roll that option before it's exercised. So either before next dividend date when there's no time premium left, or on expiration day before the close, you want to buy it back and sell another option farther out in time that has some time premium to it. Now there's a question there, like what if the stock goes up a lot and I have to pay a huge amount of money to roll it. Like if the stock's up 20% from where I sold it, you have to buy back that option at a huge loss and then sell another one, and at what strike? Do I use the strike of the original one, which is now 20% in the money, or do I pick a new at the money strike price going forward? And the answer is it depends on your personal view of where you think that stock's going to be at the next expiration date. Or if you have many shares, you can split the difference, and for half your position do one strike and half your position do another strike. There's no single right answer. It has to do with your risk tolerance level and how long you want to hold that stock.
Okay. All right. Another question here. You mentioned the buy right index earlier. Should we just buy that, or should we manually pick our stocks?
Well, I think the buy right index is an alternative to sort of just buying the S&P 500, in some low-cost ETF. It has the buy right index is probably a better alternative to buying the S&P 500 in a low-cost index fund, but they're both basically buying the market. If the market drops 10%, the S&P by definition will drop 10%. The buy right might drop 9%. They're correlated, and you're essentially very well diversified, but you're going to get market returns or slightly better than market returns with an instrument like the buy right index. So I don't personally do it because I'm not, I'm a stock picker and trader. I like to pick specific stocks that I want to own and write calls against them.
Mm-hmm.
So I don't ever buy a broadly diversified index like that. But
Okay.
if your choice, it's probably a safer bet than the S&P 500 index, if that's your alternative.
Okay. And also another one, when vol is super low like right now, is it a good time to sell calls when you have to sell so close to the money to get any decent return?
Well, there's two ways to look at that. In general, selling calls in a low vol environment is not a great strategy, but we're at the end of an 8-year bull market, and well, not the end. We're 8 years into a bull market, and who knows how long it's going to go for, but personally, I think it's a good time to start writing some at the money or near at the money, slightly out of the money calls, just because I believe, this bull market is long in the tooth. Now, if it goes up another 20%, everyone's going to hate me for saying that, and I don't know. I mean, you're going to make something, you're just going to not make as much as you could have, and for some people that irritates them, and they're probably not good covered call investors. The traditional covered call investor, my typical customer is a guy who can't make any money on bonds or on cash because they don't pay enough, and dividend paying stocks is like 3% a year with equity risk. So if you can double the dividend and get 6 to maybe 8% income between the dividend and the call premium, now you have something you might be able to live on. And that's kind of the typical covered call investor.
Mm-hmm. Okay. We got a couple more. Is it advisable to write calls on a long-term holding in a taxable account where my basis is 30 and the current price is 175? An early exercise would be really painful for taxes, even with
Can you hear
rolling.
me?
Yeah.
I just lost the audio again.
Okay, can you hear me now?
I can't hear you, Alan. If you can hear me?
Yes, I can.
Oh, okay, there you go. Now I got you.
Okay.
Sorry. I heard the first part of the question, low cost basis, and I assume it's now very high?
Yeah, so he bought at 30 and now it's at 175. An early exercise would be really painful for taxes, even with rolling and being very careful. Early exercise is still possible, isn't it?
It is, but most brokers allow you to go into the open market and buy shares to fulfill an exercise notice, and you can assign specific lots to the exercise notice if needed. So you shouldn't have to give up your low-cost basis shares to meet an exercise notice. You should be, because the markets trade even after the close, right? So you're going to get, say, an early assignment notice, let's say at the close, and then the markets still trade for the 3 hours. So if you're on top of it and your broker has somehow sent you an email saying, hey, heads up, you've been assigned, you should have time to go into the market after hours and buy some shares, assuming you have the cash, to fulfill that assignment notice.
Okay, and to do that, he would just contact his broker and let them know?
That's right. In fact, I would ask the broker well in advance of the situation
Right,
happening
yeah.
and say, what happens if, and make sure that they they can handle that situation. And if not, then you're just going to have to roll those options well before they have a small amount of time premium. It makes no sense for someone to exercise an option that has time premium in it because they forfeit that time premium portion when they exercise.
Mm-hmm.
But if it's a few pennies, you're getting really close. So I would like to, if I were in that situation, I'd leave at least 50 cents of time premium, in my position at all times. And when it got below 50 cents, roll it so that no sane, rational actor would exercise an option that has 50 cents of time premium in it. They're better off just selling it, the option, economically. But there are some irrational actors, and it can happen.
Okay. And Chuck would like to know, what are your guidelines for handling a covered call stock that drops 10 to 20% suddenly?
Yes, I have an article on that exact subject. If you search for Born to Sell stock repair, those 5 words in Google, you should find a result in a blog article titled Stock Repair that we wrote, and I talked about how to address the problem, how to think about it. It has to do with, if you were in cash today, would you still buy that stock now that it's 20% less? Or if not, get out, take the loss, and buy something what's the reason why it dropped? Is it likely to recover? It's a very big topic. I wrote a blog article about it because I get asked that all the time. So check out the stock repair article on our blog.
Okay. All right. I think that's it in terms of questions. So if you
You
want
want
to,
me to give you a 5-minute demo?
yeah, let's do that.
Okay, great. So I assume you can see my browser here with my Born to Sell homepage?
Yes.
Okay, super. So I'm going to log in, get you in behind the scenes. This is what our members see. This first page is the general search page. It has a few controls at the top where you can set the expiration date that you're interested in. The red ones are weeklies. The white ones are the monthlies.
I'm not seeing the inside. I'm just seeing the homepage of the site.
Oh, you didn't Google Chrome. You're not, is it, okay, so I'm going to log out. So do you see a login screen right now?
No, I think it's just a homepage.
Oh, hang on. I think I have 2 windows open.
Okay, now I lost that too.
Okay, sorry. I'm going to bring this back up. Oh, I know what the problem is. I'm on 2 screens here. I think it's mirrored my screens. Google Chrome. Okay.
Okay, now I see your mouse moving around.
All
There.
right. Now you see login screen?
Yeah.
Okay. Sorry about the technology, everybody here. What's going on with this? Okay. Now do you see like a general search page?
Yes.
Okay, super. So this expiration slider at the top is the expiration date we're interested in. Right now it's set till this Friday, March. The red dates are weeklies. The white ones are monthlies. The moneyness is a relationship between the stock price and the strike price. So right now it's set. It's showing us all the results between 10% in the money and 10% out of the money. Obviously, we can move those sliders around. And then the stock price is limiting the results to stock prices that are within this range. These are our 3 basic sliders or controls. We have more. If you click on this Show Advanced Filters, there are other controls that you can use to reduce or affect the results table. And the results table is this thing below, where each row is a covered call. If you hover the mouse over the symbol, it tells you the name of the company, tells you its current price, the strike that you might want to write, what you would get for it, and it knows the difference between bid and asks. It doesn't use last trades. These are actual real prices you could achieve in the real world with market orders. You can often do better if you use a limit order at the midpoint between the bid and the ask. It tells you, calculates the amount of downside protection, which is the amount that stock could drop and you'd break even. When is the next earnings date? And if it's not before expiration, it's not in red. If it is before expiration, it's in red to warn you. If there's a dividend, it tells you about the dividend, and if it's in green, it means the dividend occurs, the ex-dividend date is before the option expiration date. And then it calculates the absolute return that you would achieve if the stock is unchanged between today and expiration. And then if you annualize that number, what would the annualized return be? Now these red ones are risky because these are earnings before expiration. So if we want to eliminate all these red ones and get rid of this whole category of risk, we're just going to uncheck this earnings before expiration box, and now all the red ones are gone. So now none of the results are going to have an earnings risk associated with them. If we want to look at, you know, a week from this Friday, we can click on this different expiration date, and now these are all for a week from this Friday. If you want to go out till April for the next monthly, if you want to look at stocks that have a PE of less than 20, you can slide down to PE multiple to 20 or 21. I missed there. Anyway, you can manipulate these controls to quickly find any set of covered calls that you're interested in, and you just touch a control and it updates. You don't have to push a button that says search. We have a couple of special search modes which are kind of fun. This one's called max protection, and on this page it's a different kind of calculation. You specify the annual return that you are interested in, and the default is set to 12% or 1% a month, and then it finds every covered call that it meets or exceeds your minimum annualized return, and then it sorts them by downside protection on this page. So if we're interested in a 12% annualized return, the deepest in the money we can go is, here's a 21% on Global Blood Therapeutics. I don't follow them, so I don't know why that's so good, but the stock's trading at 36, and you could write a 30 strike and get 760 for it, lowering your cost to 29.05, and as long as the stock stayed above 30, which is the strike price, by April 21st, which is what the expiration date is set to, you will achieve an annualized return of 30.9%, at least over that time period, an absolute return of 3%. So that's kind of fun to find deepest in the money that meet or exceed a user-specified return goal. The dividends page limits the results to only those stocks that have an ex-dividend date prior to option expiration. So this is for the dividend capture people, because everything on this list has a dividend that they're going to get if the option is held until expiration. The earnings tab is one that I can't really recommend, but I do have risk-loving customers, and this is like dividends but for earnings dates. It limits the results to only those covered calls that have an earnings before expiration. So this is where you're going to find all your high volatility, very pricey options. The goal feature is unique to us. Nobody else has this. This is where you can type in an amount of capital that you have. Let's say it's 50,000, and then you type in the amount of money that you want to make. So let's say we want to make $1,000, and okay, $1,000 by when? Well, it's by the expiration date that you've chosen. So we've got 50K, and we want to make $1,000 by April 21st. Well, how many open positions do we want to have? You know, let's have 5, let's say. And are we going to use margin? We're going to say no. So that if we have 5 positions, we have 50K, we need to have 5 things of $10,000 each, and they need to produce $200 each of profit in order for us to achieve our $1,000 goal. So this is a result table of candidate trades that will help us get there. We can pick any 5 trades from this list, and if all goes well, we will meet our income goal. And it tells you specifically, this is unique to this page, the number of shares to buy, how much capital is required, and how much profit you will make if the stock is flat or unchanged between today and expiration. So that's kind of a cool tool to play some games with. The top 10 is the anonymously aggregated summary of all of our customers taken as a group. So across all of Born to Sell's users right now, the #1 covered call is Apple with the 140 strike for this Friday. And the next is US Steel, then AMD. So this tells you, what the bulk of the users are doing. And for new people, if you stick on this list, you're not going to be running too far from the herd. These aren't recommendations because we don't give recommendations, but this is just what people are doing on our site. Likewise.
So is your system tied into brokers? Is that how you find out?
No, this is self-reported. So we have a whole other tab I'm going to show you in just a second on portfolio features, and it's voluntary, so not everybody does it. But for those who do, the results are aggregated here, and this is across a significant number of people. There's no way an individual can affect this chart. It's just aggregated across a lot of people. This top 20 watch list is a similar list. We have a watch list feature which will show you, and this is the top 20 symbols that people are currently watching. So these are the ones people are typically doing covered calls on or thinking about it. Okay, so let's go to the portfolio tab. This is optional. You don't have to do it, but if you do tell us what your positions are, then you get a bunch more features. In this demo portfolio, there are 3 uncovered positions, And this is telling you the potential premium that you could earn if you were to cover them. And if you click on that link, it'll show you which options to write. Then down below, there's a section on your 3 covered positions. So there's a total of 6 positions in this sample portfolio. And for the 3 covered positions, by the March 17th date, we're going to earn $45 of time premium. And we have some downside protection of $600. So this must have been some in-the-money calls that were written against these. And then these are some, some what-if calculations. If everything was flat between today and expiration, where would we end up? If everything was called away, where would we end up? Those are the same because they must be in the money. And then if we just panic and close out all positions, options and stocks, where do we end up today? Then there's a personalized calendar which tells you for some of the positions that you own, when are their earnings or dividends and some market holidays. It'll populate as you put in your positions. So the positions tab is where you specify how much you own of what, and if you've covered it, what option have you covered it with. The dashboard shows you visually all of your positions. These are the 6 positions. We have 7 positions. Okay, we have 3 covered and 4 uncovered. Actually, I don't know why this LinkedIn is here. I'll have to go figure that one out. All time premium. The light green portion is the good stuff. That's the time premium from a covered position that you are eligible to collect. You can express it as a dollars per share or as a absolute number of dollars that you're going to collect. We're going to get $29 from this position. It's only 100 shares, and there's a little bit over here. You can then sort by time premium, and then that has the effect of showing you the small or non-existent time premiums. These are the uncovered positions, versus the ones that are covered, but maybe they're getting a little bit thin. So the question on when to roll, like this IBM position, this is obviously just demo data, but it's 100 strike for 170, sorry, it's 170 strike for a stock that's 175. So it's had a lot of intrinsic value, $500, 5 points of intrinsic value, only $2 of time premium. So we didn't want that called away. We need to roll that thing. The Cover Me page shows you it's a what-if simulator for your uncovered positions. And there's little arrows up and down here that you can click on to change the potential strike prices that you might write against any of your positions. And then it will calculate for the next 3 expiration dates what your income or profit could be, and then it sums them up. So this is a planning tool. If you have like 10 positions and you say, hey, I need $2,000 this month, you can come in here and adjust your bullishness or bearishness for each of these positions and keep working it until you get this sum number to your goal, and then go execute those trades. All of our trades are 15-minute delayed, by the way, during market hours. The Roll Me tool, this is unique to us, where you choose one of your covered positions. In this case, it's an Apple 138 strike. The top left box shows you what you currently have, 100 shares of Apple, and we shorted the March 17th 138 strike against it. The middle box is if we were to close out both sides today, buy back the call and sell the stock, what would our situation end up being? And then these last 2 boxes are some rolling calculator tools to help you plan on where to roll. This current row on the bottom box is what we have, the March 17 138. And the second row is, well, if we rolled it out a week to the March 24th and we left the strikes the same, what would happen? What's our delta? And so this last row is the difference. It's the delta between what we have and what we could have for a bunch of different categories that we might care about. Now you can click on any of the column headers in this section down here, and then it changes this box in the upper right. Likewise, you can click any box in this upper right box, and it changes the middle row on this bottom box. It's a little confusing, but they're doubly linked, and once you play around with it, you'll find it's a pretty useful way to play some what-if games and help you decide what to roll. And again, it knows about bid and ask prices. It assumes you're going to pay the ask when you buy it back, and you're going to receive the bid when you sell. So this is what you would achieve with market orders. You can often do better with limit orders. The Diversify Me is what I showed you in the slide. The gray bars is your current portfolio. The orange bars are the S&P 500 by industry sector. And so you can see if you're over or underweighted. The history page is a list of your historical trades, and you can group these by option cycle or by calendar month, depending on how you want to keep score. And That's that. The watch list is a unique feature where you can enter in whatever symbols you already know that you like, and the results will be limited to only those symbols. So if you want to trade the Dow 30, or you have a list of your 20 favorite stocks or 100 favorite stocks, you can paste them into this little box, and the results will be limited to just those.
Okay. So Mike, you've been doing this for a while. We got a question that says, can you name 3 or 4 of your favorites?
Well, the number one favorite is Apple. It's my biggest position. It has been for probably 20 years. And I write weeklies on Apple all the time. I ladder them, so I have different strikes and different expiration dates, but I'm generally 1 to 3 weeks out on that. Um, I just feel it's a safe stock. It pays a dividend, and I'm bullish on the company. Other than Apple, let's see, what do I like? It really changes week to week, and I don't typically give recommendations to my users. I'm more about teaching them the strategy and how to go about the problem, because we're not a trade recommendation service. We are a software tool to help you reduce your research time and hopefully uncover things that you may not know about. So, for example, how would if I had some money, I wanted to buy it today, what would I do? This would be interesting. You know, you start with, let's go out, I don't want to do this Friday, it's only a few days, so we'll go out to March 24th, a week from Friday. Okay, Valiant, it's just too volatile. I mean, the stock is, I can't trade Valiant.
All right.
Advanced micro devices, now this isn't too bad. This pays really well. I mean, this is at the money, it's a $14.07 stock, trading a 14 strike. You're getting 59 cents for that, and this is a 10-day trade, and you're going to make 129% annualized. It's almost a little too good, to be honest. I don't know, maybe Intel has some news coming out that's affecting AMD, or I don't trade this one day to day, so I'm not up to speed on, at this very moment, what's up with that stock. But like, my gut instinct tells me after doing this a long time that that's too rich. I don't know why that is offering that kind of a payment. What I like to do, like from my mom's account, you know, who's like super conservative,
Right.
I go to this match protection tab, and I'm seeing some ETFs in here that I don't want, so I'm going to turn off, I'm going to go S&P 500 only, and I'm going to close that back. Oh, I got the P set pretty low, but that's okay. Let me make sure I got these set. I don't want her to do any healthcare deals. I'll turn off healthcare. Okay, so now here we've got, and she wants 12% a year, so we got this. For all the things that pay 12% a year or more, what is the deepest in the money that we can do? So U.S. Steel, you know, we can sell a 33 strike for a 35.75 stock. Now this is a 10-day trade, so as long as U.S. Steel doesn't drop by 8% by a week from this Friday, you know, we'll make 26%. And that seems reasonable. I know that stock has gone up a lot lately. Again, I don't trade that one. I have to research a little bit, but I might do a small position on that. Freeport McMoran, it's had a checkered history. Again, I'd have to, diversification is key, and so I need to look at what sectors, and sometimes I'll specifically target, like, you know, hey, mom's a little light on financial stocks right now, let's go find a financial stock. And you can limit results by sector as well. If you turn off, like, let's say we wanted to get a financial stock, we're going to turn off every other sector, and now we're limited to financial stocks. So, you know, if you would light on financial, I'd probably pick something from this list, because these all have 2 to 3% downside protection in a 10-day trade, and they're all paying over 12% a year annualized. That's how this page works. Well, that's kind of how I'd go about the problem.
Okay. Cool. And Bill is asking, I don't see probabilities on the charts. Are they involved in the calculations?
No, I don't have that. We decided not to include a lot of high-end option type of statistics in our product. We're trying to sell covered calls to everybody and not just to the people who understand the Greeks and implied volatility and those sorts of concepts. So nowhere on our site will you see any mention of the Greeks or implied volatility. Now that irritates a lot of advanced option traders. We made that design decision to try and keep it simple. So you can use this tool to identify candidates and then go to, you know, your TD Ameritrade or wherever you trade, and they have all of those advanced statistics plus real-time quotes, so you can double check, you know, before you place the trade if it's within your parameters there.
Right. But I guess as a covered call trader, the big thing would be that downside protection, right? You know, how much
Yeah, for the average person, if you're buying a stock specifically to write calls against it and just try and generate some income from the time premium, then yes, the downside protection matters because you may be buying a stock you're not super familiar with and you want to know how bad could this go before I start losing money, and that is the statistic to look at.
Right. Okay. Awesome. And Bill's also asking, are the prices live or end of day? And I think you mentioned that they're 15-minute delayed, right?
They're 15-minute delayed, and we update once every 5 minutes during the market. And in the menu bar, we have a timestamp, and during market hours, that will update and tell you, when the prices are as of. And for most covered call traders, it's not day trading, so 15-minute delay is adequate.
Right. And then the other thing is that, you're quoting at bid and ask. So whatever prices and whatever percentages are here, you could probably do better. Um,
Absolutely. Almost certainly, with the limit order at the midpoint, you can do better than what we show. We made a design decision to only show what you could achieve with the market order, but you can often do better than that.
cool. Yeah. Okay. So is there anything else? Or are we done?
No, I'm good unless anybody has any other questions.
Awesome. All right, folks. So it's your last chance to ask some questions. This was really, I learned a few things that I didn't consider about before. I think I do have some positions that have weeklies. I've never done them. I've never done covered calls on them. I just do the monthlies. Um, have you noticed any kind of like an ROI difference? If like, for example,
Well,
Apple, I mean, if I do the monthly 30 or 35 days out versus if I do it every week.
the weeklies will pay better if the sum of 4 weeklies will be greater than one monthly because of the option decay curve. But it depends on how much time you have to manage your positions. If you have a full-time job and you can't be trading every day or every week, then yes, go for the monthlies. You'll do fine. You'll probably achieve 80% of the optimum. If you are a full-time trader or you're in front of your screen all day and you can trade all day, then the weeklies are great. Most people that do it real seriously with large portfolios do trade the weeklies.
Cool. Okay. And uh, okay, Chuck is asking, does your service include cash secured puts? Sorry.
It doesn't. We only do covered calls, but the time premium between a covered call and a put, a naked put or cash secured put, is symmetrical. So for the same underlying strike and expiration, they will have the same amount of time premium. So a lot of people who like to sell naked puts or cash secured puts will use our screener in covered calls to identify a juicy premium, but then go execute the trade as a naked put.
Cool. Okay. And then to sum it up, Tom is asking, how much is your service?
Sure, great question. We have 3 subscription periods. Let's see, we click on free trial. Here they are. Monthly is $59.95 a month. Quarterly is $149, and annual is $499. And I'll just go to the Option Genius URL. If you're an Option Genius listener, you get bonus time if you use the word genius when you sign up for a free trial. Enter that word in the How Did You Hear About Us field to get a couple of bonus months, depending on how long you sign up for.
Okay. All right. This has been very educational. Mike, thank you for your time. It's been awesome. Like I said, I've admired you over the years. You have a great tool here. You keep winning these awards. And for anybody who's a covered call trader, I think you really need something like this to just make your life so much easier, instead of having to go manually searching through charts and searching through different ticker symbols and whatnot. Um, so for those of you who are interested, please check it out. And thank you so much, Mike.
Great, thank you guys.
All right, bye-bye.